I'm Neil, and I'm the teacher.
And I'm Sean, and I'm the deal maker.
Together, we're the Rise Guys.
Welcome. When a huge commercial property gets sold, we always hear about the buyer and the seller. But there is another player, a really crucial one, who is usually invisible: the money itself. So where does it actually come from? Who is funding the deal? Today, we are going to break that down. At the heart of every single real estate transaction is a concept called the capital stack. Think of it like a recipe. You have got two main ingredients: equity, which is the cash the buyer brings to the table, and lending, which is all the money they borrow. In a typical big deal, the buyer might only put down 10%. That means a whopping 90% of the funding is borrowed. That is a massive amount of leverage. Public lenders are the big institutions we all know: major banks, credit unions, insurance companies, even pension funds. The key thing about all of them is that they are federally regulated. They have to follow strict rules laid out in laws like the Mortgage and Interest Act. A mortgage gives the lender a legal claim. It is their right to step in, take possession, and sell the property if the borrower stops paying. That is their ultimate safety net. Private lenders play by a completely different set of rules. They are often individuals or groups who get to set their own terms. That flexibility means they can fund deals that a traditional bank would not touch. The money can come from high net worth individuals, syndicates, or even crowdfunding platforms. One of the most creative sources is the seller themselves. It is called vendor financing. The seller basically becomes the bank, and the buyer pays them back over time using the income the property generates. At the heart of the 2008 crisis were mortgage-backed securities. The idea seemed brilliant. Take thousands of individual mortgages, bundle them together, and sell them as a single investment product. But there was a fatal flaw. Lenders were handing out huge numbers of high-risk loans. Those were the loans getting packaged and sold off globally. When homeowners started defaulting, that income stream just vanished. The products became toxic, and the global institutions holding them faced catastrophic losses. Ripple effect was immediate and devastating. Interest rates skyrocketed, and the pool of available capital for real estate deals just evaporated. Credit markets completely froze, making it incredibly hard to finance pretty much any property purchase. Both public and private lending dried up at the same time. 2008 proved just how fragile that stability can be. It really forces us to ask, are the safeguards we have now strong enough? Every deal has two ingredients: equity and lending. Public lenders follow strict government rules. Private lenders create the flexibility that gets tricky deals across the finish line. The entire system of lending is built on rules designed to create stability, but 2008 proved just how fragile that stability can be. So the question you need to keep asking is, who is really funding the deal, and what risks are hiding underneath? New webinar summary every week. Subscribe so you never miss one.